have you. You're the queen of small caps, and you say it's still time to be in them. Why?
Yeah, thanks for having me. I think even though small caps have had a really great run so far, we've gotten bullish on small caps back in September, and you saw the best quarter for the Russell 2000 in history. We've seen small caps continue to outperform by about 10 percentage points this year, but we think there's more room to run. I mean, look, we're looking for a really positive U.S. economic backdrop. Our house view is for 6.5% U.S. GDP growth this year. And, our call on U.S. large cap equities isn't that bullish. We're looking for 3,800 on the S&P 500 at the end of this year. But we think it'll be more about these rotations within the market where small caps are more aligned with the makeup of U.S. GDP growth. They're more services oriented where there's a lot of pent up demand. They typically outperform in these cyclical recoveries. So that's an area that we see more room to run. I think even though that you've seen pretty strong inflows recently, this is against a backdrop of multiple years of outflows from the size segment, underperformance. And we think this could be the start of a longer term outperformance cycle for small caps. If you look at, where relative valuations are to large, we're trading at multi-decade lows. And this typically sets you up for, a good long-term, call it 10-year run in small caps based on where we are today.
The thing is, Jill, they have already had some nice outperformance. If you look at the comebacks from the March lows, small caps are up 130%, more than even the NASDAQ from those lows. So do you worry that this has already happened?
I think when you look at the magnitude of the outperformance, when you look back at if this is the start of a longer term outperformance cycle for small caps, typically these cycles can be pretty long. Small caps have been lagging large caps since 2013. So now if we look back and say, okay, maybe March was the start of a new outperformance cycle, typically that first year is very strong and you could see, 40 percentage points of leadership relative to large. So kind of similar to what we saw over the past year. That second year, typically the amount of alpha tends to be more minimal, call it 10, 12 percentage points, but that's on average. So that's what, a little in line with what we've seen so far this year. But again, that's sort of an average level. So it could be much, much more than that. And as we think out over the next several years, I think there's a lot of multi-year bullish themes for smaller stocks where if you think about a CapEx cycle in the US, there's a lot of drivers for that, not only the cyclical recovery, but if we see a reshoring of US manufacturing, which is a big theme that we've been talking about, if you see potential for infrastructure, small caps are bigger beneficiaries of US CapEx cycles than large caps. So if we do see, that return to CapEx spending, I think that's another bullish multi-year theme for the size segment, in addition to just the overall economic pickup.
Shepard Smith here. Thanks for watching CNBC on YouTube.